Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis. Welcome to my podcast Money Talk for Thursday the 20th of July. We're one of the most listened to financial podcasts in Hong Kong and also now in Singapore, so thank you very much for your support. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, UK inflation eased more than expected to a 15-month low of 7.9% in June and slightly below the market consensus of 8.2%, mainly due to a slump in fuel prices. The core rate, which excludes volatile items such as energy and food, eased to 6.9% from May's 31-year high of 7.1%. China's Commerce Ministry on Wednesday said non-economic factors were growing and interfering with the country's foreign trade, which was facing an extremely severe situation in the second half of this year. Li Qingquan, the head of the ministry's external trade department, said some countries are forcefully pushing for decoupling, severing supply chains and so-called de-risking, which are human-made obstacles blocking normal commerce. The dollar value of China's exports plunged 12.4% in June from a year ago. The US and China have agreed to resume stalled talks over global warming as the world's two largest polluters attempt to re-engage after a year of rising bilateral tensions. Speaking in Beijing at the end of a 4-day trip during which he met senior Chinese leaders, US climate envoy John Kerry said climate change is a universal threat that should be handled separately from broader diplomatic issues. And Russia said Wednesday it will designate all Black Sea vessels heading to Ukraine's ports as military threats, potentially increasing pressure on grain prices and threatening global food supply. Russia has pulled out of a deal guaranteeing safe passage for exports across the Black Sea, and it follows 2 consecutive nights of Russian airstrikes on Ukraine's Odessa region ports, which have destroyed 60,000 tonnes of grain and damaged storage infrastructure. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com. And we're also going to talk about Asia's frontier markets with Ruchir Desai of Asia Frontier Capital. If you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, which is where you can find my daily newsletter, which is full of business and financial information from around Asia.
Peter Lewis's Money Talk.
On Wall Street, US stocks closed higher Wednesday after earnings reports from several regional banks and easing inflation in the UK reassured investors. The Dow logged its 8th straight session of gains. That's its longest winning streak since September 2019. The Dow traded 109 points higher, or 0.3% to close at 35,061. The S&P 500 climbed 0.2% to 4,566. The Nasdaq Composite added under 0.1% to finish the session at 14,358. Chinese markets fell on disappointment over China's 11-point plan to boost consumption of household consumer goods and services, which many economists say lacks concrete steps to meaningfully bolster the recovery. However, stocks did close well off their lows. Hong Kong's Hang Seng Index slid 63 points, or 1/3% to 18,952. The benchmark index was down as much as 1.6% at the low of the day. The tech index dropped 1/3%, recovering from losses of as much as 2.6% earlier in the session. And on the mainland, the Shanghai Composite Index was almost unchanged at 3,199. The Nasdaq Golden Dragon Index of US-listed Chinese shares closed 0.7% higher. That's its first gain in 4 sessions, after China vowed to treat private companies the same as state-owned enterprises, according to a joint statement from the party's Central Committee and the State Council on Wednesday. And as a result, futures markets are pointing to a small gain of 20 points, or 0.1% for the Hang Seng at the open. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests who are scattered all over the world this morning. We find our regular Thursday commentator, Andrew Freris, the CEO of Ecognosis Advisory, over in Greece. Thank you for staying up so late for us, Andrew.
Oh, the things I do for my friends.
We do appreciate it. And in Australia, we find Alex Frew McMillan, who's a freelance writer and Asia columnist for TheStreet.com. Morning to you, Alex.
I suppose I should say good day, but yes, good morning.
Yeah, good day to you. Well, let's start talking about inflation, an exciting topic to talk about when you're sitting in Greece and Australia. UK inflation eased more than expected to a 15-month low of 7.9% in June and slightly below the market consensus of 8.2%. That was mainly due to a slump in fuel prices. Services inflation eased to 7.2% in June from 7.4% in May. And the core rate, which excludes volatile items such as energy and food, eased to 6.9% from May's 31-year high of 7.1%. So headline inflation, services inflation and core inflation all lower, but all the rates well above the Bank of England's 2% target. And the Bank of England monitors closely both core and services inflation to decide on domestic price pressures and on interest rates. And over in New Zealand, we had some inflation data there as well. The annual inflation rate in New Zealand rose 6% in the second quarter from a year ago, and that slowed for the second straight quarter, following a 6.7% increase in the first quarter. That was the lowest reading since the last quarter of 2021, though prices there are still increasing at rates not seen since the 1990s. So, Andrew, panic over, isn't it? We're seeing disinflation now. Inflation seems to be slowing all over the world, isn't it? And markets getting very excited now at the fact that they seem to have avoided a recession.
Well, there are two things I imagine to understand here. It is I'm going to point the absolutely incredibly obvious, and that is inflation. It's much higher than the desired state rates, the desired government rates. Okay, in UK 7.9 as opposed to a 2%. The fact that inflation is decelerating doesn't at all merit the word deflation in the air, because if the words have got any meaning, deflation means when inflation is moving in negative rates, not in positive rates.
Could it be called disinflation? Could it be called disinflation?
Disinflation, yeah, but even that, it's quite a loaded thing. Disinflation, I have no idea. Genuinely, I have no idea what disinflation means. I know what inflation means, I know what deflation means, and disinflation means, I imagine, lower inflation. Well, if we have lower inflation, yes, that's good news, but again, boringly, it is well above target rates. Now, whether target rates are sensible or are achievable, or they make any sense in inflation maintaining such a persistence, absolute levels, we have to glance over our shoulders quickly to United States, where about 2 months ago, inflation was well in excess of the actual interest rates. Inflation was above 5%, was 6% and over, and now, wow, it fell down to 3%. Mm-hmm. So inflation can come down quite quickly. So of course, United States is not UK, it's not New Zealand, it's not Japan, but things can happen and can happen quite quickly. So I'm taking a deep breath. In the case of UK, what I'm particularly interested in is what's happening to food inflation, because food inflation is really an aching, numbing point in the public discussion in UK of what is happening actually to the purchasing power of the population with inflation rates 18% plus and over.
That's what I think I mentioned this last week, isn't it? That's what consumers notice, isn't it? They don't really care that inflation is down, 20 basis points or whatever. What they notice is, my goodness, the price of this loaf of bread is twice what I was paying for, a couple of years ago. So they notice the absolute level of things, and as far as they're concerned, things are much, much higher than they were if you go back to maybe the start of the pandemic.
And Peter, I don't want to take too much time on that. And yes, we actually pointed out that, as you say, if the loaf of bread is twice as expensive, the fact that the rate of its increase is falling is really relevant. For it to go back to where it was a year ago, then we need to have deflation. In other words, negative price of inflation. And that's not going to happen either. Yeah.
Alex, what are your thoughts here? Is this something to cheer? I mean, it does, at the very least, we can say maybe it looks like that inflation has peaked, or is it even too early to say that?
Look, I mean, I agree. The UK rate is absolutely crazy, honestly, and still way, way too high. Food inflation at 17.3%. Yeah, overall inflation just below 8% is still incredibly high. I think besides food, people really notice their mortgage going up as well, and rent going up if they rent. So those things are also incredibly punishing. And food rising also tends to punish worse the people who can least afford it, right? Because we all have to eat and we all have to buy food. So, people who don't have high disposable incomes are feeling the pinch the most there. And I think it causes a lot of suffering and is a really big political issue, which is why you see politicians getting on the case so much. Yes, overall, it's good news that all around the world, almost, inflation is easing. And I think Andrew's correct. Disinflation might be a bit of a misleading term. Deflation is a punishing situation to get into that Japan experienced for almost, better part of 3 decades. And that's disastrous for an economy. And nobody is really in deflation yet, although China perhaps could be entering it. And that can lead to a very negative economic spiral. But I think it's good news that prices aren't rising as fast as possible. But in the West and in Australia and in New Zealand and even in India, prices are still rising too quickly. And the only good news is that perhaps it has peaked, and I'm not sure you could even say it's under control yet, but it seems to be coming under control. And therefore, maybe central banks will not overreact, or we'll see the effects of their rate rises filter through, in quarters to come, because those kinds of things take time to have an effect.
But the markets are sort of assuming, or investors are sort of assuming, that the central banks have pulled off what they thought may be impossible earlier on in the year, which is that there's going to be a soft landing and they can avoid a deep recession. Goldman Sachs has cut its 12-month recession odds to 20%. Janet Yellen says she sees no recession at all now coming in the US. So do you think they're right? Have the central banks pulled it off?
I mean, so far so good. It's been tricky. It does seem like the U.S. economy in particular is resilient and hardy, and may not enter recession as many people predicted at the start of this year. So they're mainly talking about the U.S. economy there, I think. UK and Europe is in a different situation and may well enter recession in Europe. What constitutes a recession in emerging markets? Technically it's still 2 quarters in a row of declining growth, but even if you see sort of disappointing growth in China or India, that's still at a relatively high rate, that can be considered very disappointing. So, Lombard estimated that the real rate of growth in China now is 4.2%, rather than the figure that they actually cited. It does seem like a recession, a technical recession, has been averted in most places, and particularly the US.
Do you think that's the case, Andrew? Do you think? I mean, it's not the case in Europe, is it? Because several countries there are in recession. But in the US, have they pulled it off?
Again, oh God, sorry, Peter, but. I would like to call myself an existentialist economist and follow Jean-Paul Sartre, who was not an economist, but he said something very interesting. He says words are very important because that's the only thing we have. Hang on a minute. A recession really means 2 quarters back-to-back of negative growth. That's all. Okay, so to say that the United States has avoided recession means that what? That the United States in the foreseeable future is not going to grow on a back-to-back, quarter-on-quarter negative growth rate. And I'm afraid, listening to that, the almost hilarious comment that came out of Goldman Sachs, I don't like talking ill of my fellow economists. 20% chance, that's meaningless. In a year's time, the American economy, either it will be growing at a positive rate or it will be growing at a negative rate. It will not be growing 20% at a negative rate. This is. I have no idea what that means. in a year's time, we may have a 30% chance of something happening in the American economy. Probabilities are simply defined and measured in a completely different way. So let's keep those out. Hence, have we avoided or have we not avoided simply means that when I look at the pace at which the American economy is growing, I do not see any real reason why, it will grow back to back by negative rates. And incidentally, I absolutely dislike quarterly rates annualized. So even that for me, it's completely meaningless. But anyway, at least it's an agreed definition of recession.
Even if we can't sort of define it, markets or investors seem to be getting a bit euphoric about it, don't they? If you look at the equity markets, they're sort of rallying quite hard now on the fact that they believe that the Fed has pulled it off. Bond yields are falling, the US dollar is falling. The only thing is, we still have this very inverted yield curve. The yield curve spread between 10-year and 2 years at a 40-year low. But apart from that, investors are assuming that the Fed has done it.
No, I prefer to boringly bow my head and listen to what Powell has said, and unless I misinterpret that either, misinterpret that as well, or decide that his definition was not right enough, which I'm not, he said they're going to increase interest rates again. In other words, they say no reason whatsoever, in fact, that's the last. They may not do it next month, they might say the timing might be different, but till the end of the year, they're still looking for perhaps 2 25s. So, I don't want to cheer up, but that's, as they say, don't fight the Fed. There are a few times that it is worth fighting the Fed if there is a very strong positive reason why. And the reason why I reckon the Fed is not going to stop from increasing is to make quite sure that the 3% is going down to 2% and stay there. Now, it's not just a matter of hitting the target, it's making quite sure that it stays there. That's the tricky part.
Alex, the markets, they seem to be diverging again from the Fed, don't they? The Fed is saying, if you look at its dot plots, 2 more rate hikes this year. Markets are now saying just 1, and then they're going to start cutting in January.
Yes, I mean, the nature of equity markets is that they're going to front run or attempt to front run changes, and they're predictive and are trying to anticipate what's going to happen. So it does look like even if there are further rate increases, they will be few and far between, I think we can literally say. So it does seem like the Fed is done with its rapid raising of rates. And while there might be 1 or 2 small increases to come, I mean, that would mean that rates are near their peak if they're not quite at them. But yeah, I mean, NASDAQ is now up, if you look at 1 year rate, it's 22.6%. So it's actually done better in the last year than Nikkei and Topics, which had been sort of leading the way this year. So tech stocks have really bounced back with a fury. I wonder how far something like Nvidia has to run. That's sort of also benefited from this surge in interest in AI and the kind of chips that they develop that go into those machines and systems. But yeah, it does seem like U.S. investors are predicting that the U.S. will avoid recession and avoid a large amount of further rate increases.
Andrew, I wonder though if maybe investors are celebrating a bit too early and the economy's sort of run of good luck is going to come to a sharp end, because I can see some things that are a bit worrying, like manufacturing. I mean, that in several places around the world is in recession, isn't it? There is a manufacturing recession going on, but economies are being held up by the services side. Europe has sort of slid into a mild recession earlier this year, and now China, its sort of much anticipated rebound has run out of steam, and there's potentially deflation there. There are some warning signs, aren't there, before people start celebrating about the global economy? And
rather than, China, in a sense, it's an incredibly good economic example, because I can think of several points where I will be ticking them and saying not only they are growing negatively, but there are really no signs, in fact, of increasing. One of my favorite ones is the index of new home prices in 70 big Chinese cities, where the rate has been 0 to negative for nearly something like 14 months. And also, on top of that, we just had the announcement of two separate statements of policy-making bodies in China of counter recession, in inverted commas, or reboosting the economy policies. Not a great deal on promise there, but a relatively few on specific policy details, but nonetheless a statement. And also something that I found very interesting, both the State Council and the Communist Party came out with statements on the importance of supporting the private sector of the economy. So if one listens to the authorities, they are telling you that they are planning actively to reboost the economy, and therefore, yes, there is something there to be worried. In other words, I don't need to sit down and just look at my numbers. I also listen to what policymakers are telling me.
And I think you're referring there to that 11-point plan, aren't you, which the Commerce Ministry came out with a couple of days ago to try and boost consumer spending, particularly by getting households to buy more goods for their homes and to refurbish their homes. But I'm wondering, when I look through that, it sounds nice, but I didn't see what was in it, which was actually going to either give people more money in their pockets so that they could go out and spend, or give households any reason really as to why they should go and do it, other than, we want you to.
Yeah, exactly. This is exactly what I referred to. It was long on promise and short on actual plans. But this is not unusual for Chinese policy documents, in the sense they tend to be exhortatory, to resolutely do something. And then, of course, they will be doing, and I imagine they will be bringing out a series of measures. So I prefer to see this as a relatively change in the overall attitude, namely, yes, we are having a problem, and yes, we're observing it, and yes, we're going to do some measures, but please wait till the details are out. So I'm not highly critical of that, and I like the fact that both the Communist Party and in inverted commas the government, State Council, are saying that the private sector should and would be playing a much more important role in this part of the recovery.
Alex, what did you think of some of these announcements? First of all, the 11-point plan that came out from the Commerce Ministry. Clearly, the government has to do something, doesn't it, to stop the economy sliding into deflation. Otherwise, the economy is going to be in a pretty serious situation. But does this 11-point plan do it?
No, it doesn't. And it combines two sort of classic elements that the Beijing leadership love, which is a grand plan, it's a blueprint, and it's got numbers. It's got 11 of them, 11 points. So they've really turned the dial up to 11 on that one. And are sort of hoping that talking about talking the economy up is going to make it work. But I mean, I just wrote a story looking at where investors should turn other than China in Asia, since it seems like, the Chinese Communist Party and officials in the government are correctly worried and very worried about the state of the economy there. Lombard described this as happy talk, pretty much, that doesn't seem to have any concrete steps taken towards reform or making changes. So I don't think it means much. I think it is indicative, though, that the Beijing leaders are very worried about the state of the economy. And you could say that there is a mental recession going on in China, even if there haven't been 2 quarters of negative growth. Always strikes me as funny, but 2 quarters of the economy shrinking, declining. And I think they are very worried about it because, as Andrew just said, some industries like the real estate industry definitely are really in recession if you look at that industry in particular. And that is often defined as being the most important industry or the largest industry in China, and the number one place where people tend to invest their household wealth. So if their prices, the value of their homes is going down, or they're unable to make money or have confidence in investing that way. That sort of filters through to consumer confidence, to all kinds of things. And I think business owners as well, after the sort of attack on the private sector that came under Xi Jinping's plan for common prosperity, I think the private sector is also very concerned about how committed the Chinese Communist Party is to really supporting the private sector. They always put it on a par with state-owned enterprises and sort of say, well, these are the three pillars, government, state-owned enterprises, and the private sector. But they always cite the private sector third.
But isn't it ironic that now the party's central committee and the state council is saying we're going to treat private companies the same as state-owned enterprises, when over the last 3 years they've shrunk some of the biggest private companies by about 3/4 in terms of their valuation. So that some of these now are not left in a particularly great state to go and compete, are they?
And they say that, and it just isn't true. It's not true. They won't treat private companies the same as state-owned enterprises at all. The state-owned enterprises will still get preferential lending rates. They'll still have subsidies. They'll still be, considered big employers that are too important to fail. Whereas, if you're a small property developer, good luck to you. We're not going to support you. So just simply not true.
Well, what do you make of this, Andrew? The promise to treat private companies on a par with state-owned enterprises. Clearly, they're listening to foreign investors, aren't they? Who list this as one of their concerns: the crackdown on private companies and the damage that's been done to them in recent years.
Yeah, actually, I tend to have a slightly more sanguine view here. Yes, to the extent that now the party that needs every man to pull on the oar the private sector is invited to. But the 3 years back experience of squeezing the private sector, actually we have to be very fair here. They squeezed only a section of the tech sector, and this was not the tech sector that made computers or produced software. It was a tech sector that had to do with social media or social relationship media. It had to do with e-retailing and e-marketing. And this was the areas that they got squeezed. In other words, the tech sector in China, let's say those was Huawei, for example, was never put under the hammer. And Huawei actually makes things. Okay, but Alibaba was put under the hammer, and Alibaba didn't make things. It just made services. And yes, their squash was highly selective as opposed to broad. And at the time, I was quite upset by the notion that the Chinese are ruining their tech industry, because tech industry is incredibly multifaceted and varied. I said there are guys that are making things, okay, and there are guys that are simply I said, writing programs. And the two things are completely different. As part and parcel of the same overall sector, but not the sector itself. So, yes, it is interesting that they are going now, so to speak, cap in hand to the private sector. And as we all three of us have been saying, please, can we see the details now? This is very nice. Okay, we would love to marry you, and we'll say, yes, can we please have the date and the wedding ring?
I'm wondering if they're doing this.
I think...
Sorry, Alex, carry on.
I was just going to say, I think if you ask companies that are in the after-school tutoring industry or the video game industry that actually make video games, they would say that it's not true that they only targeted these platform economy companies as they're described in China. So after-school tutoring was destroyed overnight as an industry, torpedoing, billions of dollars in market value for investors. And they didn't issue new licenses for video games for around 18 months. So those are people who really make things in the tech sector. And they were heavily impacted. And if you're in the real estate industry, making buildings, I think you would also disagree that they've only targeted platform economy companies. So I think it was sort of like a random assortment of industries that tended to get attacked, and that's what scared people. And President Xi definitely was espousing some Leninist or very Marxist ideas about the need for the redistribution of wealth, and he sort of backed off that kind of rhetoric now that it proved to be destabilizing. And now they are coming cap in hand and saying, you know what, we'd really like you guys to help us out now, private sector.
And I presume it's coming because, the export sector has been damaged quite badly by all these sanctions. The Commerce Ministry was admitting that basically on Wednesday. It was saying foreign trade now faces an extremely severe situation, and what it described as non-economic factors were growing and interfering with the country's foreign trade. That was coming from the head of the ministry's external trade department yesterday.
Yes, I think trade is a problem, and then I'll let Andrew speak, but I think they're certainly concerned about trade, and they're concerned about business and consumer confidence as well.
Andrew?
Now, weaponizing trade relationships is unbelievably old news, and perhaps the Chinese should also point out that until very recently they had quite strict controls on importation of coal and iron ore from Australia. The same thing with Australian wines, which was part and parcel of political impetus. So in other words, countries such as United States employing tariffs, and why? We go back to Trump time, and we're talking about 6 years ago, 7 years ago, 8 years ago, as the weaponization of trade. This is absolutely nothing new. So also, of course, we will point out that the Chinese also, where necessary, will use trade weapons, as part of a political initiative. So, I want to say the biblical expressions, men living in glass houses shouldn't be throwing stones, type of thing, or let the unseener throw the first stone. So this was a little bit perhaps, let's say, politically insensitive, because China also participates in this type of policies. And this is not meant to be a criticism, it's simply meant to be, that's the reality.
Okay, well, thank you very much. Very interesting thoughts there. You heard there Andrew Freris, who is the CEO of Ecognosis Advisory, Alex Frew McMillan, who's a freelance writer and Asia columnist for TheStreet.com. I'm joined now by Ruchir Desai, who is a fund manager at Asia Frontier Capital. Morning, Ruchir.
Morning, Peter. Thank you for having me.
You're welcome. Now, when we spoke about 3 months ago, we reviewed for the first quarter of the year the performance of what are known as Asia's frontier markets, and they looked like they were doing pretty well. Has that continued now into the second quarter, and basically for the first half of the year? What's the performance looking like?
Yes, that's right, Peter. The Asian frontier markets had a pretty good start for the year, and also for the first half of this year, they've had a very strong performance, actually. In fact, many Asian frontier markets have outperformed the region by a significant margin. For example, Sri Lanka, which was a big underperformer last year, has seen a big bounce back this year, both in terms of in local currency and also in dollar terms. For example, in US dollar terms, Sri Lanka is up about 45% this year, and markets like Vietnam and Kazakhstan are up about 17% in dollar terms as well. So very strong start across the board for Asian frontier markets, and I think the key reason for this is, one, obviously because I think in general global markets took a bit of a hit last year with the war in Ukraine and the high commodity prices and high interest rates and high inflation. But I think these factors are now kind of softening out. You're seeing inflation coming off, interest rates are peaking out or being cut in some of our markets, and that's led to a big re-rating in all our markets pretty much across the board.
When you look at a market like Sri Lanka, it will probably surprise people that its equity market has done so well, given the very well publicised problems that Sri Lanka's had, and it's had to be bailed out by the IMF. It had a big debt. It's still got a big debt problem, hasn't it? But is it performing because people see things as improving now following that IMF bailout? So people are looking more ahead for the potential?
Right. So a couple of things, or a couple of reasons why Sri Lanka has done well this year. So one is obviously the fact that Sri Lanka's market took a big hit last year, both in local currency terms and dollar terms. The rupee saw big depreciation. There was a lot of outflows from the domestic market as well. But that led to very, very attractive and cheap valuations. For example, at the end of last year, the entire Sri Lankan market was trading at about a P of about 4.5 times. So it was extremely low. I would say it's an all-time low for Sri Lanka. So the triggers were in place, and the triggers were basically not just the IMF deal. The IMF deal came in probably March of this year, but besides that, I think more importantly, inflation was very high last year at about 50% for the better part of last year. That's been coming down significantly over the last few months. In fact, inflation was at about 12% in the month of June, and I expect inflation to be in single digits this month. That's led the Central Bank of Sri Lanka to start cutting interest rates, because they raised interest rates very aggressively last year. So they've actually cut interest rates by 450 basis points in the last 2 months. So that's really led to a lot of domestic funds moving into the equity market, which has led to re-rating. Secondly, I think earnings are also bottoming out given what has happened with high interest rates and in general slow economy. So I think you'll see pretty strong earnings recovery in 2024 given the base in 2023 is low. And I think thirdly, more importantly, is that the tourism sector, which took a big hit, not just last year because of the issues in the country socially, but I think since 2019 the tourism sector has not had a chance to recover because of the Easter Sunday attacks, and then you had the pandemic. So you had 3 or 4 years of pretty tough times for the tourism sector, but that's coming back pretty strong now. In fact, in the first half of this year, Sri Lanka has already done about $1 billion in revenues from the tourism sector, and they'll do about $2 billion this year, which is still less than about 50% of pre-pandemic levels. But if they can get back to about $5 billion in the next about 18 to 24 months, that's going to be a big macro boost for the country as well. So overall, all these factors have led to a rebound in Sri Lanka.
I visited Sri Lanka, and I have to say, if I would recommend a country in Asia for people to go for a visit, Sri Lanka would be top of the list, because it really is a stunningly beautiful country.
Absolutely, I think it was a well-known tourist destination until the pandemic and until 2019, but it's coming back pretty strong. And you're seeing tourist arrivals not just from neighboring countries like India. It's a pretty broad-based tourist arrival for Sri Lanka across the board, especially from Western Europe and the UK. So you're seeing a pretty strong rebound. And I think in general, it's a very attractive destination which still needs to be marketed in a much better fashion. And you're seeing flights return to Colombo as well. So I think you'll see Sri Lanka as one of the hot tourist destinations, I would say, over the next 3 or 4 years.
Now, tell me about interest rates, because there's very much a sense now that inflation has perhaps peaked around the world, certainly in the US. We had that UK inflation data yesterday, which we talked about earlier, and therefore central banks can maybe start thinking about bringing an end to their cycle of interest rate rises. What sort of impact does that have on the frontier markets?
Well, actually, that was the key headwind for not just frontier markets, but I would say especially emerging and frontier markets. Last year, you had a very aggressive and very hawkish Fed, which raised interest rates very aggressively. You had a very strong dollar until maybe September of last year. These are two big factors which always affect emerging and frontier markets pretty significantly, and that really played out last year as well. But I think this year, what you're seeing, at least in the last few months, is obviously in the US, inflation has kind of peaked, or in fact coming down quite significantly, and maybe the Fed does one more hike next month. But the consensus is that they're pretty much done with interest rate hikes, and that's obviously given a lot of room for central banks, I would say, in emerging and frontier markets to kind of manage their monetary policies in a more confident fashion, because if they feel the Fed is kind of done with the interest rate hikes, then they can also manage their interest rate policies. And also inflation across our markets is coming down quite significantly. As I mentioned to you, Sri Lanka's inflation is coming off. You see inflation come off in places like in Vietnam, inflation is less than 3%, so it's completely manageable. And that's led the central bank in Vietnam to cut interest rates by about 150 basis points since April 2023. You're seeing inflation come off in Central Asia as well, for example, places like in Kazakhstan and Georgia. In fact, Georgia's central bank also cuts interest rates by 50 basis points a couple of months ago. So across the board, what you're seeing is a trend of lower inflation, and that's giving confidence to central banks to either cut interest rates or hold interest rates. And I expect that going into 2024, you're going to see central banks across the universe start cutting interest rates, because inflation is going to come down pretty significantly. And that's going to be a big boost to equity valuations going forward.
Now, the other big theme around this region is the economic slowdown in mainland China, and maybe even China slipping into deflation. I mean, consumer price inflation on the mainland is zero right now. Which frontier markets are most affected by the economic slowdown, and which ones would you say are least affected?
Right. I mean, that's a great question. But I think in general, if China slows down significantly or more than what the market expects or what investors expect, I think that will be probably a negative factor for pretty much a large part of the world, because China is many countries' largest trading partner or export market or import market. But I think within the Asian frontier universe, it depends on the country and also the type of country. For example, Mongolia, which obviously borders China, depends on China for its commodity exports, and commodity is Mongolia's biggest product that they export, and China is the biggest export market. So obviously, if China does see a bit of a slowdown or a higher slowdown than expected, it could have a bit of an impact on Mongolia. But having said that, I think Mongolia's exports or even commodity exports are growing from a very low base. Because they're still exploring for a lot of these commodities. And secondly, Mongolia's exports to China got impacted very significantly last year because of China's zero COVID policies. So as China has reopened this year, in fact, Mongolia has seen their exports recover quite nicely so far this year. So it really depends on the way you look at it. And also from a tourism perspective, I think many Southeast Asian countries, for example, like Vietnam and Thailand, Indonesia, were depending a lot on the Chinese tourist revival this year, especially post reopening in China especially to help the tourism industries. But that's obviously not happened. For example, Vietnam used to receive in 2019 20% of the arrivals were from China, but that's not recovered in a significant fashion. But over here, again, I would say that in Vietnam as well, you're seeing a lot of tourist arrivals from other countries besides China. In fact, Vietnam's already got back to about 70% of pre-pandemic arrivals, which is pretty good given that they only reopened probably middle of last year. So besides, despite China not doing well or China seeing a slowdown, you're seeing other markets, take up the place of China in many of these countries. And in terms of which countries are not impacted, I would say a large part of our universe is really not impacted by a slowdown in China, because many countries don't have significant trade or investment links with China compared to, say, in other parts of Southeast Asia. For example, Central Asia doesn't have that close trade links with China compared to, say, Mongolia or Vietnam or even Southeast Asia. For example, Georgia, most of the exports actually don't go to China. They go to the rest of the region, like the rest of Central Asian countries and the Eastern European countries. The tourist arrivals are more from Eastern Europe, Russia, and Central Asia and Turkey. So again, over here, I would say Georgia really stands out in terms of having the least impact from a slowdown in China.
Mm. And which frontier markets would you say are reasonably well insulated from increasing US-China tensions, which is also a big theme? And I know in effect what you would say are not China play, because we've got quite a few investors these days who are asking for Asia ex-China exposure. Are there sort of frontier markets that sort of fit that profile? And even if US-China tensions get worse, maybe are well insulated from that?
I mean, I would answer this. I would give the answer in two parts to this question. One is, the consensus among investors is China is slowing down. They've got a demographic issue. Economic growth will not be as high as what it was in the last decade, and so things like that. So I think Asian frontier markets in general, as a universe, I think offer a good hedge or a good opportunity versus, say, China, because these markets don't have a demographic issue. In fact, they're a very young population. The median age in our markets is about 27. It's a large young population. For example, the population of Vietnam is more than 100 million. In Bangladesh, it's about 165 million. Pakistan is about 220 million. And it's young and it's growing, so they want to consume more, unlike China, which has a demographic issue. So it's completely opposite in terms of demographics in our markets. Secondly, these countries have to spend much more on infrastructure compared to China. There's infrastructure is lacking in most of these markets in terms of having modern or more developed infrastructure. They have to spend a lot more on infrastructure, which is again a growth driver for these markets. And three, there's reforms happening in these countries, and they're growing from a low base. So I would say the growth outlook for our markets is significantly stronger compared to, say, a market which is seeing slower growth rates or which has seen slower growth rates compared to the past decades. So I would say Asian frontier markets offer a good opportunity from that angle. And the second part of this answer is, I think in general, from a manufacturing perspective, as a hedge against US-China tensions, I think Asian frontier markets again offer a good opportunity because, in fact, as we've seen, which is quite evident in the numbers, Vietnam has been the biggest beneficiary in Asia from the supply chain shift. In fact, Vietnam has seen significant foreign direct investments into its manufacturing sector, which are meant for the export market, coming in from companies who are based in the mainland. And that's happened across the board. For example, companies like Samsung, Apple, even Chinese companies who supply to Apple have moved their production to Vietnam as well. So Vietnam is the prime beneficiary in Asia from this manufacturing shift, and is and benefiting a lot from the US-China tensions. And also countries like Bangladesh is actually benefiting from the supply chain diversification because of tensions between US and China, or in general, the West and China. In fact, Bangladesh's garment exports have grown by about 10% in the last 12 months, despite talk of global economic slowdown. That's a pretty good achievement. If you look at the garment export growth for other markets like Vietnam or some other countries in the region, they've been negative, but Bangladesh has shown positive growth. So also Bangladesh benefits a lot. So I would say Asian frontier countries actually are benefiting, one, because their growth drivers are much stronger as at this point in time, growing from a low base, and also they're benefiting from the supply chain diversification.
And if you could pick out of your universe one market from the Asia frontier Asia frontier market universe, what would your top pick be?
Well, I will answer this question in two parts. In the short term, I think in the next 6 to 9 months or 12 months, I think Sri Lanka can really outperform. It's had a tough few years since 2018 and 2019. The economy has not really had a chance to recover. The company's earnings have not had a chance to recover. So I think they're growing from a very low base. All the triggers are in place. They've got the IMF deal. They've announced the domestic debt restructuring. Earnings should recover next year. Valuations are cheap and interest rates are coming down. So all the triggers are in place for a continued strong rebound in Sri Lanka over the next, I would say, 6 to 9 months. But longer term, I would say, of course, Sri Lanka has to improve in terms of their macroeconomic position, the reforms and things like that. So I would say longer term, with a 3 to 5 year view, Vietnam would still be my top pick. They're a clear beneficiary in Asia from the manufacturing shift in terms of the supply chain diversification. This year we'll see a bit of a slow economic growth because of the global slowdown, but they can easily get back to about 6% plus GDP growth over the next 5 years. They have strong demographics, improving infrastructure, rising exports, and of course more attractive valuations compared to other ASEAN markets. So clearly Vietnam is the key market to watch out for in the long term.
Ruchir, thank you very much indeed for coming in this morning. That's Ruchir Desai, who is fund manager at Asia Frontier Capital. Thank you very much for listening today. Please take a look at my website, peterlewismoneytalk.substack.com, where you'll find a lot more information in my daily newsletter about the topics we've discussed in this episode. On tomorrow's programme, I'll be talking with Francis Lund, the CEO of Geo Securities, and John Schofield, Managing Director of Tempest Investment. With a view from Australia is Toby Lawson, the CEO of Staten Partners. Please join me again tomorrow.
Money Talk